My name is Dr. Neha Ogyal. I am working as an assistant professor in Chandigarh Business School of Landra, and today I am going to present a topic that is based on the financial market. So, first of all, I am going to cover these topics. The first one is meaning of financial market, then kinds of financial market, then meaning of money market, types of money market instrument, capital market, then structure of capital market, meaning of primary market, meaning of secondary market, then at the end I am covering instruments of capital market. Now, first of all, the meaning of financial market. If we segregate the two terms, financial and market, then we can understand the meaning of financial market in easily. So, what is financial? Financial is basically related to the funds and the money, and the market is basically that place where the person can buy and sell the product. So if we combine the two terms, financial and market, so financial market is that place where financial securities are buying and selling. So it is the market for the creation and exchange of financial assets. Financial assets are bought and sold in the financial market, basically market where entities can trade financial securities, commodities at low transaction cost and at price that reflect supply and demand. The cost of the financial assets are low here for the trading purpose, and the price basically reflects the supply and demand. The securities which are basically financial securities which are dealing over here in the financial markets are stocks, bonds, commodities, including precious metals and agriculture goods. So, what is securities? Securities basically is, it is a kind of receipt which is issued by the borrower, and it is issued to the lender of the lender who is promising to pay the money. Okay, so borrower here is the company or institute who is borrowing the money from the lender. Lender is the person or entity who is lending the money in the market. So these receipts are securities which may be freely bought or sold. In return of lending money to the borrower, the lender will accept some compensation in the form of interest or dividend. So when the borrower issue the securities to the lender, then he will pay some interest on that securities. Now, kinds of financial market. There are two types of market. First one is money market, another one is capital market. Capital market is further segregated into two parts, that is primary market and secondary market. So, first of all we will learn what is money market. Money market is basically that market where short-term securities are deals. Okay, so money market is that market where liquidation is very high. As per RBI, a market for short-term financial assets that are close to substitute for money facilitate the exchange of money in primary and secondary market. So, money market is that market where money-related instruments are traded, and it is basically short-term instruments. So, a mechanism that deals with the lending and borrowing of short-term funds with maturity period of less than 1 year. So, the maturity period of short-term funds are basically less than 1 year. Here the risk is very low because government is involved here. Government issues various treasury bills, and so the risk in this market is very low. So, market for low risk, unsecured and short-term debt instruments that are highly liquid are traded every day. So, in this market basically the risk is very low, and the short-term debt instruments are traded for the everyday. This market helps to raise the short-term funds for the government, and it temporarily deploy the short-term needs of the fund. Now, the main instrument of the money market. First one is Treasury Bill. Treasury Bill is basically issued by the RBI on behalf of the central government. They are issued by the RBI on behalf of the central government to meet its short-term requirement of fund. The period of issue is 14 days, 182 days, 91 days, 364 days. So, when the RBI issuing this treasury bill, this is for the short period of time, usually for 1 year, and it is issued on behalf of the central government, and it fulfills the short-term requirement of the government. They are issued at a price which is lower than the face value and are repaid at par. These treasury bills are basically issued at discount, and when it is matured, they are paid at par. The treasury bill facilitate the financing of central bank temporary deficit. They are also called zero coupon bonds. So they are negotiable instrument, and they can easily transferable from one person to another person. So next instrument is commercial paper. It is a short-term unused promissory note issued by large credit-worthy companies. So the company who are issuing the commercial paper, they have like strong capital. So then only they can issue the commercial paper. They are issuing the commercial paper to raise the short-term funds at low rate of interest in the market. They are negotiable instrument, transferable by endorsement. The commercial paper is transferable by endorsement only. They are not easily transferable, and delivery with a fixed maturity period of 15 days to 1 year. The maturity period of commercial paper is between 15 years to 1 year. The scheme of commercial paper was introduced in 1990 for the short-term financing issue. To handle the short-term financial issues, this scheme of commercial paper was launched in 1990, and they can be issued in the multiples of 5 lakhs. And as per the guidance of RBI, commercial paper can be issued on the following condition. There are some condition to issue the commercial paper. The first one is the minimum tangible net worth of the company is at least 4 crore. So the capital of the company is very strong for issuing the commercial paper. The working capital limit should have been sanctioned by a bank or financial institute. The working capital limit of the company is sanctioned by the financial institute or the bank only. In that case, the company can issue the commercial paper. Now, the next instrument is call money. Call money, it is a short-term finance repayable on demand with a maturity period of 1 day to 15 days. So call money is very liquid in nature, and it is basically repay in 1 day or within 15 days, and it is repayable on demand. When a lender wants to his money back, he can demand the company to the borrower to repay his call money. Okay, so it is basically used in the interbank transaction. One bank is lending the money to another bank to satisfy his need, and basically this call money is used to maintain the CRR ratio, that is cash reserve ratio. Cash reserve ratio is compulsory to maintain for the every bank, and to fulfill this criteria, to fulfill the cash reserve ratio, the bank sometimes take the call money from another bank, and they will repay that call money on the demand of the bank, the lender bank basically. So the cash reserve ratio is basically as per the rule of the RBI, the bank should maintain the cash reserve ratio with them. The interest rate paid on the call money loan is known as the call rate. The interest rate which is paid on the call money, that is called the call rate. The next instrument for money market is certificate of deposit. Certificate of deposit is unsecured instrument basically, and it is issued in bearer form by commercial bank and financial institution. So basically the certificate of deposit is issued by the commercial bank and the financial institution only, and they can be issued this certificate of deposit to individuals, corporation, companies for raising their short-term needs, and this is basically issued for 91 days to 1 year. The maturity period is between 91 days to 1 year. The next instrument is commercial bill. Commercial bill is actually a bill of exchange used to finance the working capital requirement of business. And a seller of the goods draw the bill on the buyer when goods are sold on credit. Bill of exchange is drawn when the goods are sold on credit basis, and the seller is the drawer in this case, in the case of bill of exchange and commercial bill. The seller draw a bill and on the buyer is the drawee, that the buyer will pay the money in the future. When the bill is accepted by the buyer, it becomes marketable instrument and is called a trade bill. When the buyer, the drawee, accept the bill of exchange, then it will come as a contract between the drawer and the drawee, and then it will convert into the marketable instrument, and it is called trade bill then. These bills can be discounted with a bank if the seller needs fund before the bill maturity. This bill of exchange or commercial bill can be discounted by the drawer from the bank at any moment within the maturity, before the maturity period, and after, so if he can do this because he needs some fund. Now, the next market is capital market. Capital market is that market where the long-term and medium-term securities are dealt. So, basically the long-term securities, the long-term financial assets are dealing over here, and these instruments, basically bonds, equities, and their shares are there. The market where investment instruments like bond, equities, and mortgage are traded is known as capital market. The primary role of this market is to make investment from investors who have surplus fund to the one who are running a deficit. So basically the motive of capital market is to provide funds to that person who actually needs the fund, and from that person who is having the surplus fund. So the person who is having the surplus money, they can invest their money in capital market, and company will raise money from that investor and fulfill their long term requirement, financial requirement basically. Now, the structure of capital market. Capital market is divided into two parts basically, the primary market and the secondary market. Now we can understand what is primary market. So primary market is basically that market in which the person in the company is offering their share first time. Okay, so when a company publicly sell new stocks and bonds for the first time, it does so in the primary capital market. That means primary capital market is that market in which company is issuing their shares first time, initially basically. When the company is in formation process, they are issuing their shares in the primary market only, not in the secondary market. So the market is called the new issue market. So new shares are basically issued in the primary market only. In this market, instruments of security market are traded directly between the capital raiser and the instrument purchaser. The capital raiser here is the company basically. Company is raising the capital from the individual, from the other parties. So instrument purchaser is the individual person or the group of person or the companies. So it facilitates the transfer of intangible funds from savers to entrepreneurs seeking to establish new enterprises or to expand existing one through the issue of securities for the first time. This primary market basically facilitates the new entrepreneurs. They can raise the fund from the primary market. They can issue their new shares, the fresh shares in the primary market, and raise the funds to establish their business. And this primary market is also used to for the expansion of the business. When the company is expand, then they can issue their new shares in this market, that in the primary market. Now, when the company is expanded and they are issuing their new shares, that is called further initial offer. Further initial offer we will study in next slide. So, the investor in this market are banks, financial institution, insurance company, mutual funds, and individual. The investor who is investing the money in the in the primary market, they can be financial institutions, bank, insurance companies, mutual funds, and the individual. Fund raised may be used for setting up new projects, expansion, diversification, moderations for existing project, merger and takeover, etc. As I told earlier, this market is used for the expansion of business as well. When the company wants to expand their business, they can use the primary market. So, in the primary market, fund can be raised for the expansion, for the diversification of the company, for merger and acquisition, and for the modernization of existing project. A company can raise capital through the primary market in the form of equity shares, preference shares, debentures, bonds, and deposits. So, in the primary market, company can issue either shares, debentures, bonds, and deposits. We will study these types in further slides. Now, the new issue takes the form of initial public offer, IPOs, or a further public offer, that is FPOs. As I told earlier, when the company is new and they are issuing their shares in the primary market, that issue is called initial public offer, that is IPO. And if the company wants to expand their business and they are issuing their shares, then that is called further public offer, FPO. Now, an IPO is the process through which a company for the first time offer equity to investor and become a public traded company. When the company first time issue their shares, that is initial public offer, then company becomes the public traded company. And an FPO is a process by which already listed company offer fresh equity in the company. Companies uses FPO to raise additional fund for the general public. Why FPOs are taken place? Because company wants to raise the additional funds for the new projects. Now, the secondary market. As the name suggests, secondary market is that place where the second time issues happen. Because in the primary market, already new securities are issued. Then the second time when the company wants to issue their security, they are issuing their security in the secondary market. The secondary market is also known as the stock market or stock exchange. So, the another name of the secondary market is stock market or stock exchange. In India, there are two major stock exchanges there. First one is NSE, second is BSE. NSE is National Stock Exchange and BSE is Bombay Stock Exchange. So, it is a market for the purchase and sale of existing securities. The existing securities who are already issued in the primary market, they are traded in the secondary market for the second and further times. It helps existing investor to de-invest and fresh investor to enter the market. In the secondary market, the entry and exit is very easily. There is no restriction in the entry and exit of the investor. So, investor can easily exit the market and easily enter the market if he wants to invest in a security. It is also provide liquidity and marketability for the existing securities. So, the secondary market provide the liquidity for the long and medium term, and they are providing marketability of the securities. It is also contribute for the economic growth by channelizing fund towards the most productive investment through the process of de-investment and reinvestment. Secondary market not only for the investment, it also contribute for in the economy, because when the company raise the fund for the project and the project is very much useful for the economy or the country, then that is contribute towards the economic growth, because that project will be successful in the future, and that also help for the growth of the country. So secondary market not only for the investment or raising of the fund for the long term requirement, but also for the contribution of the economic growth. Now, instrument of capital market. There are different instrument of capital market. Now we are going to study what are the instruments. So first of all is shares. Shares, the ownership capital of the company is divided into a number of divisible units of fixed amount. These units are known as shares. So shares are the basic ownership capital of the company, and it is further divided into two parts, that is equity shares and the preference shares, and the units in which they are divided, that is called the share. The capital in which units they are divided, that is called the share. As per section 43 of the Companies Act 2013, the share capital of the company limited by share shall be of two kinds, namely equity share capital and preference share capital. As per the Companies Act 2013, shares is divided into two parts, equity share capital and preference share capital. So now we are going to study what is equity share capital and what is preference share capital. First of all, equity share capital. Equity share capital are the basically the owners of the company. They are having all the rights in the company. The purpose of equity investment issued by the corporation is to raise fund for the firm. For issuing equity share, the motive behind that is to raise the fund for the firm. And equity shares are basically the owners of the company. They are having ownership right and they are having voting right where they are enjoying voting rights whenever there is a meeting. Now, however, in case the company suffers heavy losses and end up bankrupt, the holders of the common stock are the last one to get their money. This is the biggest disadvantage of equity shares. The advantage of equity share is that they are having the ownership right and they are having the voting rights. But the disadvantages of equity share is that they are paid at the end when the company is going to liquidate or bankrupt. Before that, creditors, bond holders and holders of preference stocks are paid. Then preference share. Preference shares are basically that type of shares issued by a company that provide predetermined dividend to the holder, unlike dividend to equity shareholder, where shareholder gets dividend as per the profit earned. So, first of all, we learn what is preference share, then we differentiate what is equity and what is preference share. So, preference share is basically that share where the dividend is paid on the priority basis as compared to equity shareholder, and and they do not have any kind of voting rights. They are not the owners of the company. So the basic difference between equity and preference share is that the equity shares are the owners and they are having voting rights, and preference shares are do not have voting rights and they do not have ownership, but they paid the dividend is paid first to preference share, then after equity shares. Okay. Now, although dividend on the preference stocks are large, but they do not get voting power of on the company matters. I already discussed this point that they do not have the voting rights, but they pay, the dividend are paid larger to them. In case of liquidation of the company, preference share get the redeem their shares before the holders of the common stock. Common stock is basically the equity stock. Whenever the term common stock is there, it reflects the equity shares. Okay, so in case of liquidation, preference shares get the money back before the equity shares. Now the debt instrument. A debt instrument is used by either companies or governments to generate funds for capital intensive projects that can be obtained either through the primary or secondary market. Debt instrument is that instrument that can be issued by the company or the government. It is a secured instrument because the interest is paid to them, and it is issued in the secondary market. The relationship in this form of instrument ownership is that of borrower creditor, and does not necessarily imply ownership in the business of the borrower. So in case of debt instrument, they are not the owner of the company because they are the creditors. They are creditors. They are providing the funds to the company, and for that company is giving regular interest to them. The contract is for a specific duration and interest is paid at specific period. So contract is for this specific period and interest is also paid for the specific period. The type of debt instrument are of different types like bond, debentures, government securities. So debt instrument can be debt, debentures or government bonds or securities. Now debentures. A debenture is a long-term debt instrument used by government and large company to obtain funds. Debentures are issued by the companies to raise the long-term source of finance. It is a certificate of agreement of loan which is given under the company's stamps and carry an undertaking that the debenture holder will get a fixed return. So it is the basically agreement in which the debenture holder gets the certificate and it is stamped by the company, and they are getting the fixed interest on the debentures. And so in contrast of equity capital, which is a variable income security, debentures are fixed income securities. So if we compare the equity shares and debentures, then the equity shares holders are the owner, and they do not they every time they do not get their dividend. Whenever the company earns profit, then only they get the dividend. But in case of debentures, debentures are the creditors of the company, so company needs to pay regular interest to them. Now bonds. Bonds are debt instruments that are issued by the companies and the government. So bonds are basically issued by the companies and government. Debentures are issued by the companies. Major issuers of bonds are governments, treasury bonds in US, gilts in UK, bonds in Germany. So basically bonds are issued in the foreign, not in India. In India, debentures are basically prefer. The term debentures is used instead of bond, and some corporate bonds are secured against assets of the company that issues them, whereas other bonds are unsecured. So bonds are secured or unsecured. Some bonds are secured against the assets of the company, and some are unsecured bonds. So if the bonds are secured, they are more safer than the unsecured. By purchasing a bond, an investor lends money for a fixed period of time at a predetermined interest rate. So when the investor wants to invest their money in the bond, the agreement is already fixed, and that is for the fixed period of time. The interest rate is determined at that time only, and that is fixed for the period of bond. During this period of time, investors receive a regular payment of interest semi-annually or annually. It depends upon the contract of the bond whether the investor receives semi-annually interest or annually, but the interest is paid on the regular interval. Issuing a bond increase the debt burden on the bond issuer because contractual interest repayment must be paid to the borrower. This is the biggest disadvantage if we are talking about the bonds for the company, because company needs to pay interest to the bonds holder at any cost, whether they earn the profit or not. So it is fixed liability for the company to pay the interest regularly to the bonds holders. Derivative instrument. A derivative instrument is whose value is derived from the value of one or more underlying asset, which can be commodity, precious metal, currency, bonds, stocks, stock indicates, etc. So derivative is a kind of agreement in which the value of derivative is basically derived from the underlying assets. So derivatives are different types. It is the different types of derivatives is future derivatives, forward derivatives, or options, swap. These are the basic common types of derivatives. The purpose of these securities is to give, produce and manufacture the possibility of hedge risk. Basically, the derivatives is used to hedging the risk, to minimize the risk. And by using derivatives, both parties agree on a sale at a specific price at a later date. Derivatives market can be divided into following as follows. So derivatives are basically used to for the hedging of the risk, to minimize the risk of the parties, and that parties are agreed to sell their financial their instrument at a specific price at the later date. Now, forward and future contract. Forward and future contract, these contracts are financial contract that obligate the contract buyer to purchase an asset at a pre-agreed price on a specific future date. So, it is a future and forward contract is a contract in which contract is made today, and the price is decided today and it is paid in the future. The contract will happen in the future but decided today. So both forward and futures are essentially the same in the nature. However, forward are more flexible contract because the parties can customize the underlying commodity as well as the quantity of the commodity and the date of the transaction. So, what is the difference between the forward and future contract? Because they are both similar in nature. The contract is made today and it is happen in future. The price is decided today and they will pay in future. But the difference is that the forward contract is more flexible and future contract is less flexible, because future contract is traded on the stock exchange, whereas forward contract is traded on the over the counter. Over the counter is that it is not traded on the stock exchange, it is between the two parties. So on the other hand, future are standardized contract that are traded on the exchange. They are future contract are basically traded on the stock exchange. They are not traded on the over the counter. Every future contract has the following features: what the buyer, the seller, the price, and the expiry date. So the buyer, the seller, the price, and expiry date are mentioned in the future and forward contract. Now the options. Options contract are instrument that gives the holder of the instrument the right to buy or sell the underlying asset at the predetermined price. So option is that contract in which the customer is having the right to buy and sell the stock at the predetermined price. There are two types of option: call option and put option. Call option is basically that option in which customer is having the right to buy, and the put option is that option in which the customer is having the right to sell the stock. So, a seller of the contract bears the obligation. He is paid a price called premium. So, therefore, the price that is paid for buying a option contract is called premium. So, the seller is basically paying the premium to the buyer. Now, what is the difference between capital market and money market? First of all, the participant in the capital market, the participants are corporate identity, foreign investor, members of the public, and in the money market, the participants are RBI, bank, financial institutions, and financial companies. The next difference is instrument. In the capital market, the long-term securities are traded. So equity shares, debentures, bond, preference shares are traded over in the capital market, whereas in the money market, T-bills, that is Treasury Bill, trade bill, commercial paper, certificate of deposit are traded. Duration. For the capital market, duration is more than 1 year. The securities are traded for the long term and medium term. The period is more than 1 year. For the money market, the trading period is 1 year. Now the liquidity. In the capital market, the liquidity is very low. The liquidity is low as compared to the money market because it is for the long term. But in the money market, the liquidity is very high. Safety. If we are compared, then capital market is more risky than the money market because here so the safety is less in the capital market. The money market is, the instrument are issued by the government and the banks, so the money market is more secure as compared to the capital market. Expected return. In the capital market, where the risk is very high, the return is also very high, and in the money market the return is low as compared to the capital market. So thank you.